Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Impinj Inc. Annual Report. Impinj Inc. offers a wide range of businesses and services through its cloud connectivity platform. The company's platform provides wireless connections to items, delivering data about the connected items to various applications. This includes endpoint ICs, which are miniature radios on a chip that attach to host items and provide identification numbers. The platform also consists of systems products such as reader ICs, readers, and gateways, which wirelessly power and communicate with endpoint ICs on host items. Additionally, the company offers software solutions that enable its partners to solve enterprise business problems in various industries. Impinj services cater to a diverse range of sectors, including retail, supply chain and logistics, automotive, aviation, banking, data centers, food, healthcare, industrial and manufacturing, linen and uniform tracking, sports and travel. The company works with original equipment manufacturers, device manufacturers, tag service bureaus, systems integrators, value-added resellers, independent software vendors, and other solution partners to provide its services. The company's platform is used in various applications such as package sortation, dock door ingress/egress, retail self-checkout, loss prevention, and more. Impinj's cloud connectivity platform provides a comprehensive suite of businesses and services that cater to the needs of multiple industries and sectors. Der Actionkurs von Impinj Inc. Pi hat sich in den letzten Jahren positiv entwickelt, was auf mehrere Faktoren zurückzuführen ist. Ein wichtiger Meilenstein war die Ankündigung des Tech-Investors Dan Niles, das Impinj ein Top-Aktie für 2026 sein wird. Dies Aussage führt zu einem Anstieg von über 510% im Aktienkurs. Ein weiterer Faktor, der zum Kursanstieg beigetragen hat, ist die positive Entwicklung des ARFID-Markts. Die Zunehmende Verbreitung von ARFID-Implementierungen für die Rückverfolgbarkeit von Lebensmitteln bei großen Einzelhändlern, wie Walmart wird zu erheblichen Umsätzen führen und Impinj Wachstumschancen steckt. Die positive Entwicklung des Halbleitermarkts, nachdem positive Daten zur US-Fabrikaktivität veröffentlicht wurden, hat auch zum Kursanstieg beigetragen. Dies Daten deuten auf ein Rückkehr zur Expansion hin und bei ein unterstützendes makroökonomisches Umfeld. Insgesamt kann man sagen, dass die positiven Entwicklungen im ARFID-Markt und der Halbleitermarkt sowie die Ankündigung von Dan Niles als Top-Aktie für 2026 zum Kursanstieg von über 510% beigetragen haben. Impinj Inc. market capitalization of $3 billion is materially smaller than most of its industry peers of roughly $27 billion. Impinj Inc. trades at a higher price-to-book ratio of 16.1 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 69% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a company can be identified through various aspects of its financial performance. The main sources of revenue include sales of hardware products, software sales, extended warranties, enhanced maintenance services, support services, non-recurring engineering development services, and licensing intellectual property. These revenue streams are influenced by customer contributions, with some customers contributing more significantly to the company's revenue than others. For instance, customer A's share of total revenue decreased from 22% to 13%, while customer B's share increased from 15% to 39%. Geographic revenue trends also play a crucial role in determining revenue growth or decline. The Americas region experienced an increase in revenue, by 13% in 2025 compared to 2024, but a decrease of 12% in 2025 compared to 2023. In contrast, the Europe, Middle East and Africa region saw a significant decline in revenue by 43% in 2025 compared to 2024. The company's financial performance also indicates a decline in net income from $40,838 in 2024 to $10,847 in 2025, as well as a decrease in operating activities, net cash provided by operating activities from $128,310 in 2024 to $58,746 in 2025. Additionally, accounts receivable increased from $56,802 in 2024 to $70,785 in 2025. Overall, the company's revenue growth or decline is influenced by a combination of factors including customer contributions, geographic revenue trends, and financial performance. The net income of a company underwent significant fluctuations between 2023 and 2025. Initially, it increased from $7,519,000 from 2023 to 2024. However, this trend was short-lived, as the net income decreased by $51,685,000 from 2024 to 2025. The reasons behind these changes are multifaceted and include various factors such as operating activities, investing activities, and financing activities. On a more positive note, the company's profit margins showed an upward trend during this period. The gross profit margin, GPM, increased by 2.2 percentage points from 2023 to 2024. Although it decreased slightly in the following year, it still managed to increase by 0.9 percentage points from 2024 to 2025. This indicates that despite the fluctuations in net income, the company's ability to maintain a healthy profit margin remained relatively stable. The reasons for these changes in profit margins can be attributed to various factors such as fluctuations in revenue or unanticipated expenses, fixed operating expenses in the short term, and changes in product mix. These factors highlight the complexities involved in managing a company's finances and the need for careful planning and execution to achieve sustained growth and profitability. The company's financial performance is a notable aspect of its overall health. One key indicator of this is the generation of positive operating cash flow. According to various sections of the report, the company has consistently demonstrated this trend. On page 46, it is explicitly stated that the company generates positive operating cash flow. This affirmation is further reinforced on page 47, where a specific figure of $58,746,000 in positive operating cash flow for 2025 is provided. The table on page 61 also supports this claim, showing positive operating cash flows for both 2024 and 2025. The report's conclusion on page 65 directly states positive operating cash flow. Yes, leaving no doubt about the company's ability to generate positive operating cash flow. This trend suggests that the company is effectively managing its finances and generating sufficient revenue to cover its operational expenses, resulting in a positive cash flow. The company's debt level has undergone significant changes over the past few years. Initially, in 2025, the balance of the 2021 notes decreased due to a privately negotiated exchange of $190 million principal amount. However, this was offset by the issuance of new convertible notes, including $287.5 million in 2021 notes and $190 million in 2025 notes. The current portion of long-term debt saw a substantial decrease from $283,493 to $96,745, while the long-term debt increased from $0 to $184,141. Furthermore, total long-term debt decreased from $283.49 million to $280.89 million between 2024 and 2025. In terms of interest expenses, there has been a notable decrease in interest expense from 2024 to 2025, amounting to $506,000. This reduction is reflected in the interest expenses for both years, with 2025 showing a lower figure of $2,339 compared to 2024's $1,122 and 2023's $1,637. The breakdown of interest expenses by year also reveals that the company paid significantly more in interest on its 2021 notes in 2024, $1,639,000, than in 2025, $483,000. However, the interest expense for the 2025 notes was higher in 2025, $3,884,000, compared to 2024, $3,234,000. Overall, while there have been fluctuations in debt levels and interest expenses, the company's financial situation appears to be improving. Management is optimistic about the company's outlook, citing continued growth in RAIN adoption as a long-term trend. The company intends to invest in developing new products and expanding its offerings, indicating a forward-thinking approach to business. Financially, the company is in a strong position, with the ability to issue new debt and generate proceeds from stock option exercises and employee stock purchase plans. Management's strategy focuses on creating a world where every item is wirelessly connected to the cloud, enabling people to access digital twins of their items. This vision is supported by the company's financial performance, which includes generating $58.7 million of net cash from operating activities in 2025. The company also has a positive outlook on its patent litigation with NXP, having won several trials and settled for $45 million. Overall, management's comments suggest that the company is well-positioned for continued growth and success, driven by its innovative vision and strong financial foundation. The company's financial policies have been scrutinized in recent reports. One notable aspect of their strategy is the decision to forego dividend payments. According to available data, the company has chosen not to distribute any dividends to its shareholders, page 38. This move suggests that the company is prioritizing other uses of its funds, such as reinvestment or debt repayment. In terms of share buybacks, there is a notable absence of information on this topic. It appears that the company has not engaged in any significant share repurchase activities. This lack of transparency makes it difficult to assess the company's commitment to returning value to shareholders through this means. Concerns about inventory buildup and supply chain disruption. The company faces significant concerns regarding inventory buildup and supply chain disruption. One of the primary risks is the potential for obsolete inventory due to regulatory changes or redesign costs, page 17. Additionally, the company's reliance on partners to sell and distribute products creates inventory risks due to long lead times, inaccurate demand forecasting, and supplier capacity constraints, page 18. The company also faces challenges in managing its supply chain, including limited third-party suppliers, equipment failures, and potential for supplier closures or bankruptcy, page 18. Furthermore, partners' overestimation of demand can lead to inventory buildup, reducing market prices and exposing the company to product obsolescence risks, page 23. The company's inability to meet market needs due to product supply shortages has resulted in negative consequences on its relationships with partners and end users, page 24. The risk of unanticipated excess or obsolete inventory is also a concern, particularly due to significant demand fluctuations, supply chain mismanagement, new product introduction, quality issues, or changes in industry standards or specifications, page 30. The company's financial reports indicate an increase in total inventory levels from $99.3 million in 2024 to $84.9 million in 2025, suggesting a potential decrease in inventory levels, page 72. However, the company still faces concerns about inventory buildup and supply chain disruption, which can negatively impact its business operations and relationships with partners and end users. That concludes the financial summary for Impinj Inc. Feel free to comment below, and I will be happy to answer them when possible.